Picture this. Two neighbors with identical salaries. One drives a luxury car, the other an old sedan. Who's wealthier? The answer isn't what you see, it's what you don't. You might think the flashy car owner is rolling in dough, but appearances can be deceiving. True wealth often hides behind modest exteriors. As Morgan Housel puts it, wealth is not about visible assets like cars or houses, but about the financial assets not yet spent. So why do we make these assumptions about money? It's all in our heads, literally. Our brains play tricks on us when it comes to finances. From how we view risk to why we can't resist that shiny new gadget, the psychology of money shapes our decisions in ways we don't even realize. No one's crazy. The personal nature of financial decisions. You might think your financial decisions are purely rational, based on cold, hard facts. But what if I told you that your money choices are shaped by invisible forces you're not even aware of? Think about your earliest memories of money. Maybe you remember your parents arguing about bills or the excitement of getting your first allowance. These experiences, as small as they might seem, play a huge role in shaping your financial behavior today. But it's not just your personal experiences. The era you grew up in leaves its mark too. Did you come of age during the booming 90s or the recession of 2008? Your attitude towards risk and investment might be completely different from someone just a decade older or younger than you. This is what experts call your financial DNA. It's a unique blend of your personal history, family influences, and the economic climate you've lived through. And here's the kicker. This DNA is mostly set by the time you're 7 years old. So next time you see someone making a financial decision that seems crazy to you, remember Housel's words, people do some crazy things with money, but no one is crazy. Their choices make perfect sense to them based on their own experiences and the information they have. Luck and risk, the unseen forces shaping financial outcomes. You might think you're the master of your financial destiny, but have you ever considered the invisible forces shaping your wallet? Let's talk about two sneaky influencers that are constantly at play, luck and risk. They're like the wind and waves of your financial journey. You can't control them, but they sure can push you around. Think about Bill Gates for a second. Sure, he's a genius, but did you know he attributes a big chunk of his success to pure luck? He once said, if there had been no Lakeside, there would have been no Microsoft. Turns out, his high school had a rare computer that gave him a head start. But here's the flip side. His friend Kent Evans, who might have been a Microsoft co-founder, tragically died in a mountaineering accident. That's the unpredictable nature of risk. Now you might be thinking, but I make my own luck. And you're not entirely wrong. It's like sailing. You can control your sails and rudder, your decisions and actions, but the wind, luck, and waves, risk, ultimately influence where you end up. This is why Morgan Housel warns, be careful who you praise and admire, be careful who you look down upon and wish to avoid becoming. So, next time you're planning your financial future, remember the wind and waves. You can't control them, but understanding their power might just help you navigate to smoother waters. The magic of compound interest, a double-edged sword. Speaking of financial mind tricks, have you ever wondered why some people seem to effortlessly grow their wealth while others struggle? The answer might lie in a concept so powerful, it's been called the eighth wonder of the world. Let's talk about compound interest. You've probably heard the term before, but do you really understand its jaw-dropping potential? Imagine planting a money tree that not only grows, but also sprouts new seedlings, each growing into its own money tree. That's essentially what compound interest does to your investments. Let's look at the master of this magic trick, Warren Buffett. You might think his wealth comes from being a financial genius, and you'd be partly right. $81.5 billion of Buffett's $84.5 billion net worth was earned after he turned 65. How is that even possible? The secret lies in time. Buffett started investing when he was just 10 years old. As Morgan Housel puts it, Buffett's fortune isn't due to just being a good investor, but being a good investor since he was literally a child. This early start allowed him to harness the full power of compounding. Here's where it gets mind-bending. If Buffett had started investing at 30 instead of 10, even with his legendary 22% annual returns, he'd be worth only $11.9 million today. That's 99.9% less than his actual wealth. Crazy, right? The art of staying wealthy, more than just accumulation. You've mastered the art of growing your wealth, but have you thought about what comes next? Keeping that hard-earned money might be trickier than you think. It's like climbing a mountain. Getting to the top is only half the journey. The real challenge? Staying there. Think about it. What strategies got you to your financial peak? Taking risks? Seizing opportunities? Maybe even a dash of optimism? Well, here's the twist. Those same tactics might not serve you well when it comes to preserving your wealth. As Morgan Housel puts it, getting wealthy requires taking risks, being optimistic, and putting yourself out there. But keeping wealth wealth requires a mindset of paranoia, pessimism, and humility. Surprised? You're not alone. Many people assume that once they've accumulated wealth, the hard part is over. But here's the reality. Staying wealthy is a whole different ballgame. It's less about chasing big gains and more about becoming financially unbreakable, as Housel describes it. So what does this look like in practice? It's a blend of frugality and paranoia, believe it or not. Warren Buffett, the poster child for sustainable wealth, didn't get where he is by constantly seeking the next big win. Instead, he avoided debt, stayed calm during economic downturns, and made his own money decisions. Tails, you win. The power of outliers in investing. You might think you've got investing all figured out, but have you ever considered the power of extreme events? Imagine you're at a casino. You're not here to play the slot machines or blackjack. Instead, you're looking for that one rare opportunity that could change everything. That's essentially what tail events are in the world of investing. Those rare, extreme occurrences that can have a massive impact on your overall returns. Here's where it gets interesting. Great investors don't just rely on steady, predictable gains. They understand the power of outliers. Take Heinz Berggruen, for example. His strategy? Buy tons of assets and hold on to them for ages, waiting for a select few to skyrocket in value. It's not about being right all the time. It's about having a diverse portfolio and patiently waiting for those few big winners to emerge. Think about it this way. 99% of Berggruen's art collection might be worth little, but that 1% that includes a Picasso, that's where the real money is. It's the same in venture capital. Most startups fail, but those rare unicorns that make 20x plus returns, they more than make up for the losses. Freedom, the ultimate currency. You might think that having more money is the key to happiness, but what if I told you there's something even more valuable? What's the first thing that comes to mind when you think of freedom? For many, it's the ability to do what you want when you want. Now, imagine if you could measure your wealth not in dollars, but in the hours of freedom you have each day. This is the essence of financial freedom, and it's more powerful than you might realize. Morgan Housel puts it brilliantly. The highest form of wealth is waking up each morning and saying, I can do whatever I want today. It's not about having a fat bank account or a fancy car. It's about having control over your most precious resource, time. But here's where it gets interesting. Studies show that having control over your life is a more reliable predictor of happiness than your salary, house size, or job title. Think about it. How often have you heard of people in high-paying jobs feeling trapped or unfulfilled? This perspective on freedom can radically change how you make financial decisions. When you start valuing your time more than material possessions, you're less likely to take unnecessary risks with your money. You might find yourself making more conservative investment choices, focusing on preserving your capital rather than chasing after the next big win. The invisible nature of true wealth. You might think you know what wealth looks like, but what if I told you true wealth is often invisible? Let's challenge some common assumptions about money and explore a perspective that could completely change how you view financial success. Think about it. How often do you see someone's savings account balance or stock portfolio? These invisible assets are the true measure of wealth, not the material possessions that catch your eye. Housel emphasizes that real wealth is about the financial assets accumulated and not yet spent. It's the money you've saved, the investments you've made, and the financial security you've built. But why does this matter? Understanding the invisible nature of true wealth can have a profound impact on your financial mindset. Instead of seeking validation through material goods, you might find more satisfaction in growing your unseen assets. There's a psychological comfort that comes with having financial reserves, even if they're not visible to others. Here's a thought-provoking idea. The wealthy individual driving a luxury car might actually be less financially stable than their neighbor in the old sedan. As Housel explains, it often signifies debt rather than true wealth. People may spend lavishly to appear wealthy, while their financial stability is actually compromised. Adapting to change. Your future, self, and money. You might think you've got your financial future all figured out, but what if I told you that your future self is a stranger? Think about who you were 5 years ago. Did that version of you predict where you'd be now? Probably not. As Morgan Housel points out, we, as people, are poor forecasters of what our future needs will actually be. This isn't just about predicting the next big trend or investment opportunity. It's about understanding that you, yes, you, will change. Your values, goals, and desires aren't set in stone. They evolve as you grow, experience life, and face new challenges. That dream house you're saving for, your future self might prefer the flexibility of renting. That high-powered career you're chasing, you might discover a passion for something entirely different. So, what does this mean for your money? It means flexibility is key. Housel emphasizes that long-term planning is harder than it seems because people's goals and desires change over time. Your financial strategy needs to be adaptable enough to accommodate these changes. But here's the tricky part. How do you plan for a future you can't predict? It's about creating options rather than locking yourself into a rigid plan. Think of it as building financial flexibility rather than just accumulating wealth. This might mean prioritizing liquid assets or maintaining a diverse investment portfolio. The hidden costs of financial decisions. You might think you're making smart financial choices, but what if those decisions come with hidden price tags you're not aware of? Every time you open your wallet or click buy now, you're not just spending money, you're also paying invisible costs that could shape your financial future. When you invest in stocks, for example, you're not just risking your capital, you're also signing up for a roller coaster ride of emotions, the stress of market downturns, the fear of losing it all, the uncertainty of when to buy or sell. As Morgan Housel puts it, if you view a decline in your assets as a fine or penalty, your future actions will likely be to avoid future fines. But if you think of it as the fee you pay to have long-term success, you'll stick around long enough to see those gains. But why does understanding these hidden costs matter? Well, imagine you're playing a game where half the rules are invisible. You'd probably make some pretty bad moves, right? The same goes for your finances. When you're aware of all the costs, both obvious and hidden, you're better equipped to make decisions that align with your long-term goals. Personal versus societal money views. Bridging the gap. You might think your views on money are entirely your own, but have you ever wondered how much of your financial mindset is shaped by the world around you? Your individual perspective is just one piece of the puzzle. Society as a whole has its own set of beliefs about money, and these can vary wildly depending on the era and culture. Your attitude towards risk and investment might be completely different from someone just a decade older or younger. Now you might be thinking, so what? My money, my rules. But here's the catch. These societal views seep into your subconscious, influencing your decisions in ways you might not even realize. Ever felt the urge to buy something just because everyone else has it? That's the power of social comparison at work. This pressure to keep up with the Joneses can lead to a cycle of irrational spending. You see your neighbor's new car, and suddenly your reliable old sedan doesn't seem good enough. But that neighbor might be drowning in debt to maintain that flashy lifestyle. As Housel warns, people do some crazy things with money, but no one is crazy. Their choices make perfect sense to them based on their own experiences and the information they have. So, how do you bridge this gap between personal and societal money views? It starts with awareness. Recognize that your financial decisions are shaped by both your personal experiences and broader societal influences. By understanding these forces, you can make more intentional choices about your money rather than being swayed by invisible pressures. The seduction of pessimism in finance. You might think you're making rational financial decisions, but what if your brain is secretly drawn to bad news? It's a quirk of human psychology that can have a big impact on your wallet. Ever notice how financial doom and gloom seems to grab your attention more than positive economic news? There's a reason for that. As Morgan Housel points out, pessimism is more captivating than optimism because it is viewed as less risky. Your brain is wired to pay more attention to potential threats, even in the world of finance. Think about it. Which headline would make you stop scrolling? Stock market crashes 30%, or economy grows steadily for fifth year. The crash, right? That's because negative financial news feels more urgent and actionable. It taps into our instinct for self-preservation. But here's the catch. This tendency towards pessimism can lead you astray when it comes to long-term financial planning. While it's important to be aware of risks, constantly focusing on worst-case scenarios can paralyze you with fear and prevent you from making smart investment decisions. So how do you strike a balance? It's about cultivating what Housel calls balanced optimism. This means recognizing that while setbacks are inevitable, the overall trajectory of the market tends to trend upwards over time. It's like planting a garden. You know there might be storms or pests, but you still expect your plants to grow. The danger of financial narratives. You might think you're immune to financial hype, but what if I told you your brain is wired to fall for money myths? Let's explore how stories can hijack your wallet and why critical thinking is your best defense against financial folly. Have you ever wondered why some investment trends take off like wildfire, only to crash and burn later? It's not just about numbers, it's about narratives. Our brains are natural storytellers, and when it comes to money, a compelling tale can override logic faster than you can say, get rich quick. Think about the last time you heard about a hot new investment opportunity. Did your heart race a little? Did you feel a sudden urge to jump on board? That's the power of financial narratives at work. As Morgan Housel puts it, stories are, by far, the most powerful force in the economy. They can drive markets to dizzying heights or plunge them into panic, all based on the stories we tell ourselves and each other. We're more likely to believe stories that confirm what we already think or want to be true. It's called confirmation bias, and it can lead us to make irrational financial decisions. You might ignore red flags about an investment because the story of potential riches is just too tempting. So ask yourself, what really matters to you? Is it freedom, security, or the ability to make a difference? Your answer might just redefine your entire approach to money.